Well, I think the key positives have been the uptick in the net interest income coming through. That's big surprises to the upside, particularly in the net interest margin. And that's because the cost of funding hasn't increased quite as much as we were expecting. Although, as you were pointing out, deposits have been flowing out of these institutions, those people are still putting some money to work with them and not demanding too much in return for those deposits. So that's still a work in progress, but certainly big upside on net interest income.
What's it going to take to stem those deposit outflows, the ones that are coming, not the shift from some of the small regional lenders into the big banks, but the true deposit outflows that are going into money market funds for people to get better yield? What kind of deposit rates are needed to stem those outflows?
Well, it's going to be very difficult for them to stem those entirely. Obviously, the banks are offering a little bit more in savings accounts now themselves. And offering some quite attractive rates in CDs as well, also above 4%. So I think they'll look to retain as much of those within the banks as they can. But naturally, some people will be looking for high yields of, sort of towards 5%. And that means you will continue to see this cash sorting of deposits moving off balance sheet. But the banks are well prepared for that. They did have a huge influx of deposits from during the pandemic. And you still got excess deposits within the system as well. So they're actually in a very strong position to withstand that.
Are the bigger banks going to be slower to increase their deposit rates than some of the smaller ones? I mean, maybe a silly question, but what's the sort of the relative deposit rate outlook there?
You're right, the banks don't need to go and chase those deposits, so they're unlikely to put up huge rates to try and attract too many new deposits. Obviously, at the beginning of March, we had a lot of turbulence in the banking sector, and the big banks benefited from that with a lot of flows from the regionals to the majors. And as I pointed out, the majors already have excess deposits as well. So they are seeing rising deposit betas within the consumer sector, but they're not going to chase those deposits. They have what the big banks have really focused on is having a large amount of operational deposits, so day-to-day savings rather than sort of long-term savings. And that means that those users are unlikely to move their money too much outside of the big banks.
Let me zoom in on Goldman Sachs, which is due to report earnings later today. Goldman has a sizable money markets business, and that's obviously been where a lot of the deposits have been flowing. To what extent is that going to support Goldman earnings, and is any upside from that business already priced into the stock?
Well, that part of the business should do quite well and benefit from some good flows. However, it's a reasonably small part of the overall Goldman empire. Much bigger part is the investment banking and capital markets divisions. And there it's going to be a little bit more mixed. What we've seen is some very weak investment banking activity going through. That's a hangover from Q4, where it just hasn't been much activity at all. That will hurt them. On the trading side, we've seen good FIC numbers, and Goldman Sachs typically does well there. They're much weaker equities trading. So I think you'll see some mixed numbers on the sort of the more important parts of their overall business.